Hello, welcome. My name is Kiryll, and I'll be your host today for a special presentation about the recent events about Silicon Valley Bank and Signature Bank and the collapse and what that might mean for Australian investors and the wider market as a whole. And join me are special guests, Greg Canavan, is our editorial director, and also with me is Ryan Dinse, editor of Crypto Capital. Hello to you both.
Hey, Kiryll.
Hey, Ryan.
Now, as I said, today's live stream is all about the collapse of Silicon Valley Bank and the repercussions. Now, likely, if you're already watching the video, you know the basic facts surrounding the collapse, so we won't bother you too much with the rehash. But we want to discuss in detail, the implications of these events and the opportunities, especially, what does it mean for banks, for investors, for the wider economy, and especially since in Australian context, what does that mean for Aussie investors? So we'll also try to discuss the US Fed and its likely response, especially given the recent inflation data that came out overnight. We'll also look at the outlook for stock markets and also the role of gold as a monetary signal, and we might even mention Bitcoin. Now, I'll just want to start off and say, what do you guys think about the collapse? What are your initial thoughts? Basically, what happened?
I might kick things off. I'd firstly say good day to everyone listening. Looking forward to the chat. Without going too much into the detail, and if we look at take a step back a little bit, the Fed has raised interest rates by around 475 basis points in the space of 12 months. So that is a significant monetary tightening in a short space of time. And one of the things that I often write about to subscribers of Fat Tail Investment Research is there are lagged effects of monetary policy. And just because at a certain time things look to be going well, and even though the Fed's been raising rates and things look to be going well, doesn't necessarily mean all is well. And the narrative of the last month or so has been, is it going to be a soft landing? Maybe it's going to be no landing, all this sort of stuff. But the market has not been aware of the fact that these monetary policy, the tightening has lagged effects. And I think what we've seen with Silicon Valley Bank is the first indication of this rapid tightening in monetary policy, because really what happened is they got a whole bunch of money that was a result of the quantitative easing and the huge fiscal stimulus that happened in 2020-21. A lot of that money went into tech. Obviously, they're a banker for venture capital firms. So they got a huge amount of deposit inflows that came in, easy money, and they had to do something with that. So as a banker, you can either invest in securities or you can loan those funds out to businesses, real estate, that sort of stuff. They had a lot of deposits coming in, didn't have a lot of necessarily loans to make. So they invested a lot of their incoming deposits into things like mortgage-backed securities, treasury securities, which at the time were yielding very, very low. And that's before the Fed had started raising rates, right? So the way that bonds and fixed interest works is when the yield is really low, the capital value of that security is high. And as yields go up, the capital value goes down. So this Silicon Valley Bank had a lot or nearly all of their assets in a classification called held to maturity, which means that you're not allowed to actually hedge against it. So there's been a lot of comments saying irresponsible risk management. They didn't hedge their book. And that is true to an extent, but that's because they put all of their securities in held to maturity and they couldn't actually hedge the interest rate risk. So when interest rates started going up, the value of their securities portfolio started going down. Then when depositors started to move their money out, they were effectively insolvent pretty quickly. And Ryan might expand on this because I know we've had discussions on it, but in a fractional reserve banking system, it's inherently unstable. And as soon as there is the slightest concern over a bank and over the bank's balance sheet and depositors start pulling their money, there's always a mismatch between the need for short-term liquidity versus the ability to supply that liquidity through your securities portfolio. And that's exactly what happened. Then when they went under, everyone went, who else is in a similar situation? So the short sellers started targeting these other banks. and here we are. But my sort of main comment from it would be, this is just the result of a very sharp monetary tightening, and it's really not, I'm not saying it's the start of a banking crisis, but it's the start of a new narrative in the markets of, hang on, the economy is slowing down, there are some issues out there, and where's the next domino going to fall?
Yeah, I think you've explained that well, Greg, and that is the basic story in a nutshell for Silicon Valley Bank. I think where the wider implications come in is, like in America, for example, unlike Australia, there's lots of banks, there's hundreds, if not thousands, of banking institutions around America, a lot of small and regional banks, as well as your big four New York banks and things like that. And banks go bust in America. It happens, not regularly, but it does happen every few years. A bank will go bust because, like you said, they'd mismanage risk either in their loan book, which would be a credit risk, or they mismatched their maturity to the deposits, and there was a bank run. So that kind of stuff does happen in America. And at the early stages of this crisis, that was the narrative being sold, that this was something individual to Silicon Valley Bank or Silvergate or Signature or somehow related to tech. At first, it was related to crypto, then it was related to tech. If that was true, then you wouldn't have seen the extraordinary reaction from the federal government and the Treasury, which happened on Sunday night. And I think what people are realizing is that record pace of interest rate rises that came has caused something in the banking system to break. And no one is quite sure where that is, or what the extent of that is, should I say. And that is why you had the Fed come in with this massive bailout package, because if it was just individual risk to SVB Bank, then it would fail. Depositors would get some of their money back, shareholders would be wiped out. But the fact was, this asset mismatch was pretty endemic throughout the US banking system. From some figures I've seen, there was around about $600 billion of unrealized losses on the US banking balance sheet. Now, that varied from bank to bank. Some banks, like Silicon Valley Bank, had really large losses, which pretty much wiped out their regulatory capital base, which means they're insolvent. But even on other banks, it was still wiping up to 50, 40, 50, 60% of their regulatory capital base. And the way a bank works is it needs to keep certain minimums of regulatory capital in order to be a bank, essentially. And these are set by regulators. Now, if there was a massive run on deposits on Monday, which is what some people were threatening on Sunday night, then every other bank, small regional bank that had these unrealized losses on their book would have to realize those losses and essentially really harm their regulatory capital bases, which means they would need to then raise money from capital markets, which would be really hard to do in a panic situation when people are worried about banking. So that was the situation, and that's where the contagion effect came in. It highlighted what Silicon Valley Bank highlighted was, yes, they were probably more badly managed in some ways than the other banks, and in some ways they had this weird deposit base of startup and tech money, which was very, you couldn't really rely on it to be there. But at the same time, it did highlight another feature of the whole banking system, which was a lot of them were technically insolvent, but due to this held to maturity rule, it didn't show up on their balance sheet. But to me, it just shows the fragility of the US financial system. And now we're left in a situation where every single banking deposit in America is now underwritten by the US government. Now, the second and third order effects that come from that now. So they've stopped the bank run, and for now they've put out the immediate fire of a bank run. But now that the US government is essentially underwriting every single depositor in America, what is then the effects of that? So one, if nothing else changes, then it actually creates this moral hazard situation where banks can be incentivized to take more risks, because at the end of the day, the depositor base is guaranteed. The executives get money out of the bonus structures. So, everyone is in a win-win situation. On the other hand, it could go the other way. Now that the US government is underwriting the deposit base, maybe they're going to go very hard on increased regulations. And this is then a trend towards centralization of banking, towards more control from government. And I think both outcomes have consequences that maybe people don't appreciate fully. So that would be sort of my take on the situation. I think it's a wider issue, albeit caused by a specific issue in a bank, which highlighted that wider issue. But we need to start thinking about what the second and third order effects of this are for banking, because whatever happens there flows into the rest of the economy as well.
Hey,
Yes,
one thing I'd add to that, Dinse, is the reason why depositors are a little bit flighty is because interest rates have gone up so quick, right? So money market rates are quite attractive, and banks have held their deposit rates down in order to make a margin, the net interest margin, that it is the lifeblood of their profitability. So the attractiveness, now we're in a higher interest rate environment, the attractiveness of other forms of deposits have incentivized them to move away. Now, I know there's an argument to say it's a bank bailout, but I'm not sure if the US government or the Fed could have done anything else apart from guarantee all deposits. You either guarantee all or you guarantee none, because if you try to say, I'm going to guarantee a certain level, it creates that level of panic, because as we said, the fractional reserve banking system is inherently fragile. The money, the short-term liquidity isn't there to satisfy everyone's demand deposits. So something, needs to be done like that in order to stop the potential for a bank run. So I think they did the right thing, but as you said, what happens after? What happens down the track?
But that's the fragility of the system, and again, that comes back to what happened in the GFC, where the risks are borne, the profits are borne by one section of society, but the risks are socialized amongst the others. And this is, no matter what they call it, that is that happening again. Actually, on that point, I did note there were two applications for new banks in America in the last couple of years. One just a few months ago, which actually their proposition to the Fed was that we will be fully reserve banks. We will keep one-to-one deposits, so they won't invest them in long-term maturities. And the Fed turned both them down. And the reason they turned them down is interesting. It was because by being safer than every other bank in America, that would cause a potential risk that all the deposits would come to them and cause a bank run. So they were penalized for being safer than what is proposed. And that's a really interesting, thing about banking that people might not realize, is they think that money is money, but the money in your bank is not, it's a form of money, but it's actually a loan to the bank, essentially. And our whole financial system is built on this hierarchy where there's different levels of money, and one level of money is an asset. So money in the bank is an asset to us, but it's a liability to the banking system. And the bank has the same thing at other levels up as it goes towards a central bank. So there's all these layers of double entry accounting of assets and liabilities. And people don't realize that until something happens, like over the weekend, where some depositors in some of these banks realize they might not be able to get their money out on Monday. And like you said, I don't think the US government had a choice, because there was going to be a bank run on every single smaller bank in America on Monday. Whether that was justified based on their financials or not, it was going to happen. And because of that unrealized loss situation, it was going to cause severe damage to equity in a lot of different banks. So yes, they had to do it. But my broader question is what does that say about the system that we live in? And that cost doesn't evaporate into nothing. It does get borne somewhere else. And in our system of money, it gets borne at the top layer of money. It gets borne by the currency, ultimately. The currency gets debased over time. And that's what, we call it money printing. And I know that's not technically correct, but it's creating an unlimited supply of something which papers over these cracks that appear from time to time. And to be honest with you, this is only something the US can do. If you go to other countries that are struggling like now, like Argentina, which has got 100% inflation, or Turkey or Lebanon, they can't do that because they don't have that privilege. So fiat banking system, fractional reserve banking system, America might be able to paper over these cracks to some extent, but a lot of other countries can't do that. And that's something to bear in mind.
Yeah, I thought I'll just jump in there. Ryan, you mentioned the word contagion a few minutes ago, and Greg, you were saying that monetary policy acts with a lag, and maybe now things are starting to potentially break. So one question that many people have is, is the collapse of Silicon Valley Bank an outlier? Are the circumstances surrounding that bank unique to it, or will it, in your view, have a high risk of leading to contagion? Or maybe the Fed's and the government's involvement has now sort of tamped those fears down.
I think the contagions happened. The response by the Fed was the contagion. So they had two choices with the contagion. One was to do nothing, let these banks fail in the normal way. and the result would have been a bank run on Monday, which would have had wider effects, or they did what they did, which was to come in and say, we will basically, technically what they did was they said, all these unrealized losses that you've got on your book, if you need, we will allow you not to realize them if you need to, so you can borrow the full value. So the analogy would be is, you bought a house for $1 million, suddenly interest rates went up and your house was only worth $700,000, but your bank said, hey, you can still borrow that extra $300,000 if you need to for whatever reason. You know what I mean? So that's sort of the analogy that's been given. So right now, depositors don't need to worry about a bank run, because with these held to maturity assets, something to realize is that they've not lost the value initially there. It's just the value of them has decreased at this moment in time, because right now you can get a higher interest rate than you could when these bonds were first bought. So it's not like a credit risk, which is where, they'd made bad loans and they'd lost the money. They still have the money. It's just today's value is less. So I think from your question, the contagion's already happened. We need to start thinking about what is the next steps from that. And that's what I was trying to say earlier. The next steps from a banking point of view are more regulation, more centralization, more power for the government, or alternatively, it's they don't do anything. But then that increases this moral hazard to bankers, because then they can say, hey, well, the depositors are guaranteed. What can we do with this free money? But then that brings into inflation thing. So we've just spent the last, year and a half trying to take money out of the system. Now bankers now have access to all this extra money, and there's no risk or less risk to them for doing stuff with it. What happens if they start injecting that money back into the system? So there's a lot of different sort of questions to think about.
And that ties neatly into the next topic, which is obviously the US data, inflation data was released yesterday, and inflation is still very sticky. Core inflation is actually, I think, risen 3 months in a row now. So inflation in the US is not really coming down as fast as the Fed would like. And that just sort of raises questions about, does the Fed now have competing interests? First, it has to preserve the stability of the banking system, and now it has to also deal with high inflation. So how do they reconcile those two things? And what will the Fed do? What's the outlook?
Yeah, so the Fed meets next week, and you always say, oh, this next Fed meeting is going to be very important, depending on what they do. But really, this one will be very interesting to see whether they continue their we are inflation fighting narrative, or whether they will realize what's going on, and that the events of the past week or two are an indication that monetary policy is quite tight. Like if you look at real interest rates, they're still quite high. And that is in many ways a real barometer for how loose or tight monetary policy is. You've got M2, which is a indication of money supply in the US. That's negative for the first time in history. Like money is quite tight in the US, and that is starting to be felt. Inflation is a lagging indicator. So the inflation stats that you're seeing now are still, quite old in terms of what's happening. The market has started to look ahead. I mean, the yields on the 2-year Treasury note fell at almost the fastest pace in history. I've read stuff to say it's the fastest ever, the sharpest fall since the 1987 crash, that sort of stuff. But it indicates to you the market has turned on a knife and said, we think interest rates should be cut. Whether the Fed does that or not is another question. I think if the Fed comes out next week and says, we are still raising rates by 25 basis points, I think the market falls really, really sharply. And that'll be a signal to say, you have got this wrong. That there is some real trouble here. And I don't mean trouble as in more banks failing. I mean a US recession coming into view, corporate profits starting to come under pressure. The PE ratios of where they are at the moment are too high for an economy that's potentially going into recession. And if you look at the performance of, say, the banking index in Australia even, that has fallen sharply in the past couple of months. So there's been this, and one of the good things about looking at equity markets and stock prices is that they're forward-looking barometers of market of the future, whereas the stats that we get and the stats that the Fed is evaluating, like unemployment data and inflation data, they are lagging indicators. So personally, I would rather focus on what the stock market is saying. And the stock market is saying if the Fed keeps rates higher, then it's going to cause a deepening of this bear market, another leg of this bear market. Even energy stocks in Australia, that index is starting to roll over now. And energy has been, I guess, the one sector that has stood quite firm in this bullish uptrend, while other sectors have really struggled in this interest rate tightening period. Whereas I think now energy's stocks are starting to say, okay, the economy is going to slow in the short term, and it's starting to discount that stuff in. So next week's going to be really important, I think.
Yeah. I think on Greg's point there, I think the Fed will not change course, but I think they'll pause. And the reason I say that is there's a lot of political pressure coming from people like Elizabeth Warren and Democrats that are very worried about the economy because, it's all fine for markets to go up and down, but when real people start, losing jobs and stuff, that hits home, especially to politicians. And there's a lot of pressure coming on Powell. He's coming under pressure for how he's managed his banking crisis. The economy is, I think, starting to roll over, if not already. If you look at some other signs of inflation, I've been following some real-time data, which I don't know how accurate it is, but it seems to be, to me anyway, it seems to match quite well. But it shows that in the last 2 weeks even, which is not the data the Fed will be using, but in the last 2 weeks, transport costs and food costs have fallen dramatically. And you can see that anecdotally from looking at some headlines recently. I think shipping container costs, for example, were 76% lower in the last quarter than they were in 2022. In China, there's steep discounts on new cars right now. Toyota even offered a 2-for-1 deal on new cars, which is quite extraordinary. And that suggests, at the very least, an inventory buildup and a slowing down in demand. And I think a lot of people had this narrative in their head that the China reopening would be hot for inflation and hot for the economy. And I don't think that's the case. You can see it in oil prices, which I checked this morning was about $71. That's coming down as well. As Greg said, energy markets are starting to roll over. All the signs are that the economy is in trouble. We had a heap of tech layoffs in the last few months. And just this morning, Facebook, called Meta now, has announced another 10,000 layoffs. So as Greg said, there's this lag effect, right? And I think the Fed was always of the view that let's raise interest rates as far as we can, because when the economy does go down, we can always cut. And the more you raise, the more firepower you give yourself to do that later on. And I think we've reached the point, though, where something's broken, which is what the point is that they were wanting to get to. It's probably happened a little bit earlier than they wanted. They probably wanted to get a bit higher, but now something's broken dramatically. I think it constrains them from doing too much else, because you've got to realize you've got a lot of debt in the American system. You've got government debt, which is going to roll over from really low interest rates. And if interest rates are still high, in the next 6 months, year, the government itself will have to pay a lot more interest. You've got a heap of commercial debt as well in the next 6 months that rolls over. So commercial loans on properties and things like that. Now, that debt would have been done, 2 or 3 years ago at 1.5%. And that's going to roll over to, 4 or 5% or more with commercial loan margins. That's hard for businesses to take. And even, anecdotally, Fat Tail Investment Research are moving office because we're looking for a cheaper lease because work from home and things like that. I mean, people don't need this office space. So I think the commercial property sector is another potential canary in the coal mine. And that could be another reason to be a little bit wary of banking stocks, because as these commercial leases roll over, there's no guarantee a lot of them will be retaken up by corporations that now have people working from home and don't need the office space and things like that. So I think there's a lot of factors that are now, we're always there, but now we've had the crisis. It now gives the Fed the excuse or the point in time to say, hey, let's just pause now. We've done a heap of tightening. Let's just pause, give people a bit of relief, see what happens next. I don't think we're going to go to QE and cutting, but in saying that, the bond markets are saying that very thing. They're now pricing in cuts by the end of the year, which before they were going to have a higher terminal rate. So the market certainly thinks there's potentially cuts coming a lot closer now than they thought a week ago.
Just a question on that, Dinse. I was going to ask you whether now that they've ring-fenced the contagion and guaranteed all deposits, do you think in the Fed's mind they're saying, well, we've dealt with that issue, now we can go back to fighting inflation? And as Kiryll said, core inflation is still stubborn. Do you think that they move back onto that fight? I mean, I'm with you. I think they pause. But if they're if they're stubbornly inflation fighting and want to prove to the market that, you know, this banking issue that we've dealt with is not going to derail us from this, do you think they?
I don't think they do. I think the inflation. I know their whole idea was to like really knock inflation out before they stopped raising. I know that was their intent. I just think now they've broken something in America. Now, let's be honest, they were breaking stuff around the world before that. There was a bond crisis in the UK last September, which was due to those, you know, rapid increase in interest rates. Emerging economies are getting smashed. Inflation in Argentina is 100%. Their currencies are worth nothing, you know, in Africa. So things were breaking in the rest of the world. And you've got to remember that will feed into the global economy too. But I think they were always of the view, well, as long as America's taken over, we'll keep on increasing rates until inflation comes down. My point now is I think inflation is starting to come down because the economy is now tangibly slowing down. And I think now the risk to them is on, well, it always was on going too far, but I think now they're very conscious of we go too far. So I think they've got an excuse now to either stop at this meeting and say, we'll just see how things go, or raise a quarter of a point, but change the language on future rate rises. But the bond market is already saying they will.
Yeah.
I think what you said before, though, is if they do continue we're going to be hard on inflation, we're going to keep these rate rises come, you will see an almighty crash in various markets because the market will say you've got this wrong. But that will mean probably a reverse, of course, quicker as well. So I think, Kiryll, we want to speak about some investment opportunities. I think that is the time, well, now is the time to start thinking about those possible outcomes. And if a crash comes, is that an opportunity or not? You know what I mean?
Yeah. And I think now we can maybe sort of switch the attention more to the Australian context. And, you know, speaking of central banks, just quickly, do you think that the recent events will sway our own Reserve Bank, or will they even be paying any attention to what's been happening in the US? Or what do you think they're saying?
They'll be paying attention, and I think, you know, the last time the RBA met, so that was roughly 2 weeks ago, they already indicated that they were getting closer to the point of potentially just sitting back. And RBA is in a slightly different position to the Fed because we've got variable interest rates in Australia. So the transmission from interest rate rises to the economy is probably a little bit quicker than what the Fed. So they're under probably a little bit more pressure to sit back and say, okay, well, let's just see how these rate rises have gone. And don't forget, like, our interest rate rises have been very rapid as well. We started raising rates in May last year, so it hasn't even been 12 months since the RBA started raising rates. So it makes sense to, I think, at least go on hold. And if the Fed does it in a week's time, it'll make it a lot easier for the RBA to do it in their meeting in early April. The other thing to note with the RBA is that they, like all central banks, they increased their balance sheet considerably during the COVID crisis. And in their monetary policy statement, I think they release it quarterly. I think that come out in February, and they indicated that they are running the balance sheet down and it will contract by about 15% this year. So there is a little bit of quantitative tightening going on in the Aussie market as well. And for a 15% contraction in the balance sheet this year, that is a reasonable withdrawal of liquidity from the financial system in Australia. So I think the issues in the US, they always flow through to Australia. If you look at our banking sector, our banking index has fallen really sharply. And that really, the precursor for that was Commonwealth Bank's half-yearly result that came out in February. And that was almost as good as you get result. You know, their profitability was great. Their return on equity from memory was about 14%, which is almost like a cyclical high for the banks. So it got sold off on really good news. And when that happens, you know, everything's priced in. And from that moment, it's just been down, down, down. And then these revelations have really made the market price in more risk into banks, saying, okay, well, our banks are solid. They look pretty solid, but what don't we know? And therefore, should we be paying this multiple for the banks, or should we be paying a lower multiple? So I think, and the other issue is, you know, the depositors and their ability to get a better rate of interest elsewhere, because we all know that banks really hold down their deposit rates to try to increase their profitability. So the question is, do banks have to raise interest rates on their depositors and take a hit to profitability to do that? So, there's plenty of reasons to be cautious on the banks. But in saying that, I do think the RBA go on hold, and I would be surprised if interest rates go up any further from here in Australia.
Hey, Greg, a question for you on that. So I've been watching a few of the non-big four banks like AMP and Bendigo Bank and stuff like that. They've fallen a little bit hard in recent weeks. Do you think if there is a general panic, which is maybe not as not as applicable to Australia as it is to America, do you think that is buying opportunities in non-big four banks, or do you think at this stage in proceedings you wait and see what happens and steer clear of that just in case the risks are unquantifiable?
I would tend to think that it's a buying opportunity. If you think about, yes, Australia's got lots of debt. Yes, we've got high household debt to income ratios, all that sort of stuff. Our government's got lots of debt, but so is everywhere in the world. So it's all relative. We also now are generating consistent trade surpluses. So we've got, considerable iron ore, coal, LNG exports that bring a lot of money, income into the country, and that underwrites the ability for us to service that debt. You've also got net migration running at about 200,000 people a year. It's back to record highs really quickly. So you've got population growth, you've got resources that are bringing in income. So for me, it just doesn't feel like there's a reason to be overly bearish on Australia. And I would say if there is a general panic, I think even the banks could look at being good buying opportunities. I'm certainly looking at
what is the risk? The risk would be property price falls in Sydney and Melbourne, and maybe business lending falls in the smaller banks. They might have more of their money there. That would be the risk, wouldn't it? That would be the risk that interest rates do keep on going higher, property falls, and defaults rise.
That's actually the time to buy banks, is when their provisioning for bad loans increases. And I think that was one of the things with the Commonwealth Bank over the past couple of years. Their provisioning for bad loans has been really low, which has inflated their profits. So once you see those provisions really jack up because the economy might be slowing and loans are going bad and they have to write off some bad debt, it looks ugly, but that's the time when you buy the banks, because it's that cyclical low point. I think we're probably some time away from that, given that they've just had a really good couple of years. But depending on how low share prices get, if we do get a panic, and who knows, we might not. Like it might just be a sort of a slow grind of a market where there's some sectors that are hit, some sectors that continue to do okay. Like there's a whole bunch of stocks I got on my watch list that were hit really hard in the sell-off last year. And if people are familiar with the Aussie market, we made lows back in June last year, and a lot of those stocks haven't breached those lows. So, and even in the past couple of weeks, with a lot of the selling that you've seen in the banks, a lot of these stocks that I'm looking at have sort of held up pretty well. And a good rule of thumb is to say, okay, if you like a stock and you want to see how it performs relative to the market on these down days, if the market falls by 2% and the stock you're looking at is down by 0.5%, then that's a solid outperformance on the day. So you're thinking, okay, well, most of the selling is concentrated in other areas, and everyone who's wanted to sell this stock has probably already sold it. And if it's showing that good relative strength, then, you might be looking at a stock that's in the process of bottoming anyway. So it's important to realize that it's not just a stock market we're looking at, it's a market of stocks. There's loads of different sectors, loads of different things that are influencing earnings and prices and all that sort of stuff.
Well, speaking of stock markets and markets of stock, I think viewers are probably looking forward to this section, which is, what are the opportunities that you are seeing there for Australian investors in particular? And also maybe more generally, what should Australian investors maybe be looking for right now? What should they be monitoring? I think, Greg, you recently wrote to your subscribers about the importance of gold as a monetary signal. So maybe you both can talk about that.
Yeah, sure. I'll kick off. So in terms, I'll just be broad. instead of naming stocks, I'll just talk about sectors that I think are interesting. Gold is, I think, a really interesting sector at the moment. It's been through a 2-year bear market. The Aussie gold index fell around 50% from peak to trough, and the trough was in September last year. Had a big rally from that low, correction, but I think this is a time to be buying the gold miners. A lot depends on what happens with the Fed next week, whether they continue to run a tight monetary policy or whether they signal that they're going to go on hold. So that'll have some influence in the short term. But I think longer term, gold stocks are looking quite good. The other sector that I'd be interested in, if we do see continued weakness, is energy. I'm talking coal, oil, gas. All those commodities are supply constrained over the long term. We don't have the supply to meet demand. And when we're talking about a short-term demand hit from global recession, I think that'd be the time to actually step in and buy, because we will get a recovery. And when we do get a recovery and demand turns around, the supply is just not going to be there to meet that increased demand. And I think if you can pick up good quality energy stocks in this correction and hold them for the next couple of years, I think you'll be doing very well. And I think there's just a good bunch of quality growth stocks in Australia that have fallen anywhere from 40 to 50% from their highs, that are worth looking at in terms of, if you want to hold something for another couple of years in the next bull market. And if you think about it, the US market's already been in a bear market for over 12 months. So if we're calling this a bear market, it's already long in the tooth in terms of historical precedent. In Australia, it's a slightly different story, because we made our highs back in August of 2021, hit those highs or got close to those highs a couple of times, but never quite breached them. So we've been sort of going sideways in a consolidation pattern. So my view would be just to buy on those sort of dips where it looks like things are are pretty bad, and you get those good opportunities to buy. I think you need to be a real contrarian in this market. When everyone's panicking, you're seeing, the headlines of, bad stuff. You've got to selectively look to start deploying capital.
Yeah, I'd echo those sentiments. I think now's the time to get excited rather than panicky. It doesn't mean you go all in, and it doesn't mean you can go gung ho. Exactly. But I think, for example, in my wheelhouse, it's small cap stocks and crypto and Bitcoin. But I'll give you an example. One of the stocks in our small cap portfolio is up 25% since September last year, and that is 160 million market cap small cap, earning revenue, earning profit, got good growth prospects. It's up, about 25% in that time. Meanwhile, the small cap index is down about 20% over that same time frame. So my point would be there is that there are good small cap opportunities, but you have to be selective. But the upside to that is if you can really nail one of these early growth stories, everyone else will want the same stock, because they're not going to go for the riskier things now, because the mindset is don't touch risk. It is going to be harder to raise capital, because when yields are higher, the equation is it's harder to attract that capital when people can earn safer money. So in a weird dichotomy, I think small caps is bigger opportunities for the right small caps, but you need to be more careful than ever to avoid the rubbish. And in small caps, there is quite a lot of that, unfortunately. You need to avoid the narrative stories, the story-led stocks, which did well in 2020, 2021. Try and avoid them, because they probably won't find they have the money to keep going before they get profitable. And even at the venture capital level in Silicon Valley, that's a risk for some of those companies now that the venture capital money has sort of slowed down. A lot of them are not profitable for years. How are they going to get that runway if people stop writing them checks? And that's the same with, kind of mining stock, small cap miners as well. It's saying that they're more cyclical and more driven by commodity prices, so that maybe they're slightly different. Coming back to my favorite asset, Bitcoin, the thing I would note about that is that it's up, 25, 30% since, Friday last week. So it's the interesting thing about that is it's had this massive inverse correlation to the US banking system, which is one of the value propositions of Bitcoin that people might not appreciate. There are risks with Bitcoin. Of course there are. It's a new technology. There's very volatile pricing, but you have to understand the benefits and the fundamental value of Bitcoin too, which is it's an asset without counterparty risk. So you're not relying on the bank holding it. If you hold it in your own wallet, you're not relying on a custodian or anything like that. And there's another subtle point about Bitcoin is there's no inflation risk in terms of the currency can't be inflated away, which is what we talked about at the start, is usually all of these solutions, what they actually end up doing is just increasing the supply of fiat currency. With Bitcoin, there's a set 21 million amount. So I think those two key fundamental aspects of Bitcoin really highlighted the value proposition of Bitcoin. And in a weird twist of fate, it highlighted it to a bunch of very wealthy Silicon Valley investors who probably underappreciated that aspect of Bitcoin because they were too carried away with various, cryptocurrencies that they thought could do this and that. And they ignored the real fundamental driver behind the whole cryptocurrency movement, which is Bitcoin. And so you've got a lot of these investors that suddenly had this, aha moment where they realized they might not be able to make payroll next week because their money might be frozen by a bank. And I've seen a lot of chatter amongst, VC investors on Twitter and stuff where they're thinking an allocation to Bitcoin might be a smart hedge in terms of having an access to a liquid pool of funds that you can deploy anytime, just in case. So before, the idea of having Bitcoin on your treasury was the idea of having a long-term asset that would hopefully rise in value over time. But now another use case is having this, liquidity hedge of this always available money that can't be frozen, censored, or stopped. And to put that in context for you, over the weekend, while the banking system was shut down, there was over $33 billion worth of transactions happened on the Bitcoin blockchain. That no one could stop. Most of these transactions happened for mere dollars. That's over 600,000 transactions happened. So you had this always open financial network which wasn't relying on this US banking and fiat monetary system. And that's a hard sell a lot of the time, but sometimes in moments like over the weekend, that becomes a very clear value proposition. And the way I try and pitch that to people is it's not a either or situation. It's you've got this fiat banking system, which most of the time works fine for a lot of people, but it does have this systemic risk which can blow up. And depending on what country you live in, they can be fatal to your savings. So having a hedge, which is Bitcoin, having some allocation in your portfolio to this hedge, to me, is just a simple matter of risk management. It's a matter of, whether that's 1% of your portfolio or 2% of the portfolio. It's a matter of having an asset, the only digital asset anyway, that lives outside the financial system and operates on different rails than the existing banking system. And I think what the weekend highlighted was there is value to that. Now, what that value is the open question, and time will tell as who values that and who doesn't. But I'll give you an example, a non-Western example. I think over 40 million Nigerians actively use crypto and Bitcoin on a week-to-week basis because their banking system is just not trustworthy. So depending on your situation you come from, you can see that value proposition a lot clearer. But the interesting thing this weekend was it actually became clear from a Western point of view as well. And I think it could be a seminal moment for Bitcoin. You never know with these things, but a 30% jump and a complete inverse correlation to normal markets was a very interesting thing for traders to look at as well.
I was going to say, Dinse, I look at this sort of stuff from a macro perspective, and I look at Bitcoin and gold as being very similar in terms of their role that they play. As you said, no counterparty risk. There's no one on the other side of the trade. When you're talking about physical gold, there are futures and derivatives and that sort of stuff. But gold and real interest rates move inversely, right? And I mentioned earlier that real interest rates have moved sharply higher in the US over the past year or so as the Fed has raised rates. And my contention has always been that there is too much debt in the US and global economy to be able to handle sustainably high levels of real interest rates. And my view is that the real interest rate needs to come down, otherwise something will break. And that happens by having lower nominal yields, basically. And when over the weekend, the real yield, when I'm looking at real yields, I look at long-term average real yields, fell from about 1.65% to about 1.5%. That's not a huge move. It's around about 10% if you look at it in terms of the actual move in the yields. But gold and Bitcoin are very sensitive to those moves. So it's no surprise to see gold shoot up, and it's no surprise to see Bitcoin shoot up even more on the back of that fall in real yields. So if I'm right in thinking that the US economy can't sustain those higher yields and over time they will fall, then I think we could be looking at a bottom for both gold and potentially a move to new all-time highs by the time this year's out, and certainly a bottom for Bitcoin, given that it has been under the pump for the past, 12 months or so. So yeah, it's looking from a macro perspective. I know all the stuff that you touched on is probably more the micro reasons for it, but from a macro perspective, I think it looks quite interesting as well.
Yeah, okay, and a point taken, yeah.
And I'm just conscious of the time, so I don't want to put you both on the spot, but if you
I'll put you on the spot.
Any concluding remarks or any key takeaways that you want investors and Aussie investors in particular to take away from this conversation?
I'll kick off. Sorry, I would just say that always keep in mind that the stock market is a forward-looking indicator, and when there is panic and headlines, the stock market has probably discounted that in already. If it's in the headlines, it's in the price. So and it's very difficult at those times to try to put your emotion to one side and look rationally at prices and say, okay, well, it's now a good time to buy a long term. But I would just try to put that in the back of my head, because I know it's easy to say when you've just had a couple of banking collapses that things could get worse and all that sort of stuff. But I genuinely think we are moving into a slower economic growth environment, whether I don't think we'll go into a recession in Australia, but I think the US is probably quite close to recession at the moment. That generally brings about good buying opportunities, but it's very difficult to do so when you're seeing in the headlines US in recession, banks going bust. You think, okay, what's next? What's coming next? But that's what that would be my concluding remark, is to look at share prices, look at valuations, and try to look out where are these going to be in 2 years' time. And I don't think we're in a 2008 environment where the banking sector is so impaired with overvalued property that it's going to cause major global banking issues. I don't think that's the case. I think this is just a standard good old-fashioned recession brought about by higher interest rates and a cycle of rising rates that will then turn over at some point this year to lower rates. And then the lagged effects of lower rates will cause a bull market down the track. So I'm actually looking forward to, at least the next 3 to 6 months and hope that there's plenty of buying opportunities there.
Yeah, I'll agree with that. And essentially it's a matter of timing that dynamic of when does the effects kick in and how does the stock market react in the interim. A lot of times you can be right with a thesis on the stock market, but get your timing wrong. And I think that's the hardest thing probably is, do we have more falls ahead before the central banks pivot or before the market says, well, you have to pivot. And so we'll start pricing that in. Timing, that's hard. Our colleague Murray does that very well if you're looking for someone who's got the trading nous to do it. But I think from my perspective, I sort of live in this investing paradox in my own head where I'm very bearish on the entire financial system long term, but I understand that they have the tools to manipulate it pretty well in the short term. So how I handle that is by using downturns to look for good quality growth stocks in my case. Because I think the central banks will eventually do whatever it takes to keep things pumping along, and that will last for a while. But at the same time, I think of my portfolio and I think of Bitcoin as a hedge against that eventual outcome or that possible outcome where they manipulate it so much that enough people lose faith in it, whether that's people in the US or whether that's just foreign countries. And I think that's why, Bitcoin and gold, if you're you like that sort of thinking, make a viable part of your portfolio as a sort of fail safe against that. It might not happen. The probabilities are low, but the upside potential, if it does happen, is massive. And it's the asymmetricness of it as a risk hedge, which is the attractiveness from an investment point of view for me. So I'd encourage people to use these times to investigate Bitcoin. Don't necessarily trust what you hear in the mainstream media about it. It's a decentralized network. It does a lot of good for the world. It allows, people in emerging economies to have access to an entire financial system, which a lot of people don't. It allows people to escape currency debasement. But even for us in the West, it sort of, in my head, it performs the role that gold historically did, which was keeping the central bankers honest. By having an alternate ready to go, you make sure the people that have got this immense power to direct who gets money and who doesn't can't abuse it too much. So even if it just sits there and acts as this threat, that is a valuable proposition in my head. So Bitcoin as part of your portfolio, look into it, experiment with it, make sure you custody it in your own wallet, because otherwise there's no point in it. And from the small cap growth story, tech's down quite a lot this year. Tech is an area I'm really excited at. The thing about tech you've got to remember is these are exponential technology curves that aren't going to slow down no matter what happens in the daily gyrations of the market. And industries like synthetic biology or artificial intelligence, different materials. We're going to, like, something me and Ryan Clarkson Ledward have been talking about recently is how we're going to go beyond silicon on microchips, and there's going to be all these new materials going to be needed to power the supercomputers of the future and power quantum computers and AI. That's all coming. No, it doesn't matter what happens in the market every day. That's all coming. So if tech goes through this period of a downturn, that is a huge opportunity for anyone that has any type of 2, 3, 4 year investment horizon. But to take advantage of that, you have to do the work. You have to start to understand what you're investing in, what are the short-term risks, and what are the long-term upside potential. So to me, the next 6 months could be pretty exciting for investors, but as long as you don't let emotions get the better of you, and as long as you do the research to know what you're buying and what the risks are.
Yeah. Well, I think thank you both, Ryan and Greg. It was very insightful. I hope the viewers enjoyed it too, and we'll definitely be following this story along over the weeks ahead. So stay tuned for more content like this. And also, if you want more information, you can also check out our site called moneymorning.com.au, or our main site, which is Fat Tail Investment Research. So again, thank you to Greg and to Ryan. And
no worries. Thanks, guys.
Thanks, Kiryll. Thanks, everyone.